Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Don Pollard, and Don is a Chartered Life Underwriter, or CLU, and also a Chartered Financial Consultant, and he is an insurance broker that practices in San Jose. Don's worked in the insurance industry since 1973, when he was 3 years old. We wish.
That's right.
Yeah,
that's right.
Anyway, he's managed insurance agencies, trained agents, built employee benefits departments, and he's currently a broker serving individuals and small businesses in San Jose. He's the past president of the Silicon Valley chapter of the National Association of Insurance and Financial Advisors, and he currently represents the local chapter to the National Association in Washington, D.C. Because healthcare insurance is such a critical area, we devoted some interviews with Don discussing healthcare reform and so forth, and choosing medical insurance that you can find on our financialinsiderweekly.com website. But I guess part of what we're going to talk about today an awful lot is change that's ahead. So, we've just had an election. Today is November 22nd, 2016. You're going to be seeing this sometime after that. And obviously, we don't have all of the answers, although we may speculate somewhat about this. We make this sort of an interesting interview. Related to that. Another thing, though, to be aware of is that the rules for medical insurance vary a little bit from state to state, so you need to work with a consultant who's familiar with your state laws. Don, thanks for joining me today.
Oh, Mike, it's great to be here.
Okay, thank you. Yes.
Under the circumstances.
Yes, there you go. All right. Well, I guess we got our election result. Mr. Trump has been elected president. So now what?
Well, in your introduction, you said we were going to, we don't have all the answers. I'm going to put a caveat on that, as we don't have probably any of the true answers at this point. But I think after 18 months of campaign rhetoric and hype, there is one thing that looks inevitable, and that is that there's going to be an effort to replace and repeal the ACA, the Affordable Care Act, better known as Obamacare. More than likely for the Republicans, this is required to satisfy their base of voter. But then on the other hand, to scrap the whole thing it would require kicking some 20 million people that now have insurance that didn't have insurance before off the rolls, if you will, and more than likely that's not going to be politically expedient in any way. I will say that that due to the campaign rhetoric, there was a thought that there was nothing in Obamacare that was any good, and that's really not the case. That's not even the case that the GOP is putting forward. So on the interview that President-elect Trump did with Lesley Stahl on 60 Minutes, he did refer to several of the provisions of the plan, mostly market changes that they intend to keep. And one of those was the provision for children to be able to remain on their parents' policy up to age 26. I don't think anybody objects to that. And also the pre-existing condition exclusion, which precludes insurance companies and HMOs from denying insurance coverage to people that have pre-existing conditions. So I think the thought of most, and my thought as well, is that those provisions will remain, but as for the rest of it, it's hard to tell at this time.
Yeah, well, obviously there are many people who are very worried. You mentioned 20 million, that sounds like, I'm not sure, it's a pretty good percentage of the U.S. population. I don't know, we have like 200 million or something.
About 300 million.
300 million, okay. So anyway, so still, that's a pretty decent percentage, I guess about 7.5% or something like that. And so I can't see myself, and again, I may be being naive, but I can't see how they would make a real dramatic change related to this particular matter during the first year, because people are already getting their coverage for this year. They're signing up, on the exchanges and so forth for coverage, and so they're relying on that coverage being there.
Most of the thinking now relative to the timeline for change is that, and that's a good point you make, is that in 2017 nothing's going to change. It's going to be the same, possibly 2018. But the thinking is that for any of these provisions that were going to affect large numbers of people, that they're going to do it today and then have it become effective later, like 2 years from now or something like that, to give people an opportunity to make some other arrangement.
Right.
So yeah, that's a good point to bring up. Though, is that there isn't, it's still the law,
Yeah.
and that's not going to change for next year, and all the subsidy mechanisms and the policies and the premiums and everything, those are all in place.
Uh-huh.
So I think from that perspective, you're right to say business as usual for this next year, but certainly stay tuned.
Yeah, and even when the law was enacted, so healthcare reform was enacted, as I recall, back, was it 2010, wasn't it?
Yeah.
And so it took several years for them. So it's really just sort of been hitting home just the last 3 years,
Right.
For most people. And so we're starting to see how it plays out. I guess we'll move on a little further along that because it's been hit in the news about insurance companies bailing out. Maybe you could talk a little bit about that.
Well, yeah. Let me just describe the landscape for the exchanges relative to healthcare and access for people to have opportunities. So in 2017, according to a study by the Kaiser Foundation, 57% of exchange enrollees will have a choice of 3 or more carriers. Now, each carrier provides multiple plans. So as you may have known from our former interviews, there's 4 tiers of insurance coverage under the Affordable Care Act, basing from bronze, which is the least costly, to platinum, which is the most costly. And it's up to the insurance companies how they want to internally design their policies to fit within those particular categories. So in any case, but I think from a competitive standpoint, the idea would be the more insurance or HMOs you have involved, the more potential for competition. So that number, 57%, is down from 85% of the enrollees had 3 carrier options plus all the plan options. In 2016, 22% will have a choice of 2 insurance companies / HMOs, and 21% will only have 1 carrier to choose from. Now again, that carrier might offer 30 or 40 different plans, from the most cheaply priced bronze plan to the most costly platinum plan. Aetna is the most recent noteworthy player to bail out of the exchange, and they said they're doing it for unprofitability reasons. There's 3 big players that have done this: United Healthcare and Humana, and the 3 of them account for about 2 million participants. So they're not a major player, I wouldn't say, in the particular marketplace, but certainly they're big players across the country. So it's important that they have not done that. Now, there's been subsequent reporting by the Huffington Post that in relation to the Aetna bailout, if you will, it was just 8 months ago when they said they were excited about the exchange and they were looking forward to it, and it turns out that the Huffington Post disclosed a letter they had uncovered from the CEO of Aetna, Mark Bertolini, to the U.S. Justice Department, that he was threatening to leave the exchanges if their attempted merger with Humana was blocked.
Oh.
And subsequently it was, and therefore, we have this now. Who knows whether that's the actual reason or not? I don't know, but these are the kinds of things that go on.
Now, as I understand it, well, one, we've got, related to this, some significant price hikes that have been publicized. And as I understand it, California wasn't impacted as much as some of the other states. They have, a lot of them are using a federal exchange, actually. They're not using one that's been designed by their own state. Mm-hmm. And California was one of the early states. Well, of course, we've got the biggest population, so.
And the biggest exchange,
yeah,
the most successful.
Yeah.
Yeah.
So maybe you could make some little comment about that, or?
Yeah, well, the California exchange is different than the nationwide situation. In the nationwide, the average price hike was 22% this year. And I was reviewing a chart of the changes in the prices, and it went from like 700% in Alaska down to a -2% in Alabama or someplace like that. But anyway, so that all averages out to 22%, which is really not what anyone expected to have happen. Now, President Obama has said that, well, yes, the prices went up, but the subsidies went up as well. And so basically people should not be in a different relative situation than they were before. Now, I will hurry up to say that in my own experience, that has not been the case. So the premiums on the programs of some of my clients have gone up, as well as their subsidies, but not in equal proportion. So they are ending up paying more for their coverage. Now it's not anywhere near 22%, and in fact I think our exchange was a 9 or 10% increase on average. Now certainly the idea of the multiple tiers of plans is that if you have a silver plan, which is like the second most comprehensive plan in value, and the price goes up too much for you, well, you can always go down to a bronze plan, which is priced to cover 60% of your expenses and therefore reduce your premium outlay. This is always a possibility, unless, of course, you already have the bronze plan and it goes up, and then you're kind of stuck. But the problem with that in any event is that if I reduce my monthly outlay of premium, what happens is, by definition of medical insurance, is that when I go for my services, the price goes up. Mm-hmm. Okay, because I don't have somebody intervening on my behalf and mm-hmm. making those payments. So again, it's a slope that has lots of crevices and curves, and the calculations that they use, they're based on zip codes. They're based on coverage, they're based on their ages and expected premiums. So the subsidies, there is a formula for that, and it's complex. That's what I can say for sure.
Okay, and we're not going to get into too many details related mm-hmm. to subsidies and so forth today, but what I did want to point out is that in order for people to get a federal subsidy, in other words, to have a reduction of your premium because the government U.S. government is covering a part of it, that has to be done through an exchange, correct?
Yes.
Yeah.
Well, that's how it is at this time now.
Yeah.
Now, one of the proposals from the Republicans, or part of the GOP proposal for the replacement health care, is that there's a universal credit that's applied to everyone, and there's no requirement that you buy insurance through an exchange for this. And they will basically get rid of all the subsidies through the exchange and just give everyone a tax credit to be used, rich and poor. It doesn't make any difference. So currently, though, you're right. That's how it is. In order to get that, you have to go through and purchase a policy through the exchange. Mm-hmm. If you purchase an individual policy through one of the carriers, then you're not going to qualify for that.
Right. Okay. So with all the other things we're talking about, I don't know if we're going to have time to talk too much about that sort of stuff, but nonetheless, I think it's important for people to understand that's how the system works now. And like you said, the Republicans have made a proposal that that the credit may be available in some way outside of exchange, and so we'll see how that all plays out.
Now,
okay.
this universal credit is disclosed in their plan that they have posted.
Mm-hmm.
That's part of how they're gonna make things better.
Uh-huh.
And frankly, the average in a subsidy in our California exchange is $3,020 a year per person. So, and the GOP proposal suggests $2,500 of universal tax credit. So, I'm not exactly sure how they pay for that, but that's what the scenario looks like at this point.
Yeah. Well, yeah. So anything that we talk about related to proposals, I think that there's going to be some heavy negotiations that are going on in Congress. There are still a few Democrats that are sitting there.
I mean, look, you're absolutely right. And when we talk about repeal, I mean, repeal is not guaranteed because they don't have the supermajority. They only have 51. They need 60 for that.
Yeah.
So they're subject to the filibuster. I think the thinking is more than likely this will happen through that reconciliation process where they basically cut off the funding for these things, which then, makes them die, right?
Yeah.
If they cut off the funding for the subsidies in California, our exchange will not survive.
Right.
Because 90% of our enrollees through the exchange have a subsidy at this time.
But part of what's going to happen with all of this too is as people are impacted, if they're negatively impacted, they're going to scream to their congressman.
Sure.
And it doesn't matter whether they're a Republican or a Democrat.
Yeah, that's right.
So
because there is another election coming up in 2 years.
Right. Okay, well, I guess the next question is what do you think is doable given this environment?
Well, it looks like, there's some agreement on some things. One of them is the mandate to buy insurance. So basically, a mandate means it's a requirement. That's really not what it is currently. It's a you need to get insurance or pay a penalty. So they allow you the opt-out, but you do have to pay for that. And interestingly enough, that was originally a Republican idea back in the day when Clinton was trying to get his health care plan put through. But so the issue here, though, is if you'll recall, part of the benefits of the Affordable Care Act is the no pre-existing exclusion. The insurance companies at the time that this was brought up said, "Well, we can't just take all these people in without some provision to make up for the losses that we're going to have, because what we're going to get is anti-selection, which means I'm not going to get the insurance until I need it, and then I'm going to get my procedure done, and then get out again." So this the mandate was part of that whole process. So my suspicion is when the mandates, if they do get rolled back, repealed, whatever it turns out to be, there'll probably be some howling from the insurance carriers that, hey, wait a minute, what's going to happen to us now?
Yeah.
That now we're not going to make that up because everybody has to have insurance. And so we're going to do something else. So there are a couple of ideas out there to alleviate that problem. And Paul Ryan, Speaker of the House, has a single open enrollment period idea that basically allows everyone the opportunity to come in at one given time, say a 3-month period of time, sometime in the future. You can come in and buy insurance then, and if you come in and buy insurance at that time and keep that insurance, then you'll always be able to switch plans without worry of any pre-existing condition exclusion. Mm-hmm. However, if you miss that period, or for some life reason, can't do it or won't do it or don't do it, then you're basically subject to the whims of the insurance company as people were before. That sounds like a big risk for many people. I'm not sure
Yeah.
that's really a good way to do it. So there's another way that has been talked about, and that is to have a penalty similar to the Medicare Part B penalty, and that basically says that for every year you don't buy Part B, you have to pay a percentage greater in the next year that you do buy it. So it's a 10% cumulative kind of a thing. They have the same for Part D Medicare. My suspicion there, though, is that at 10% of the premium, if you're talking about $800 a month, that can get pretty expensive pretty quickly. So I think that might be a little tough.
Okay.
There.
So there's been discussion also about selling policies across state lines as a way of trying to increase competition and reduce premium and so forth. So you have any particular comments related to that?
Well, I think the key to know about that particular provision is that's already permitted. Companies can sell across state lines. However, the industry has really not addressed that in any way at all, basically. So nobody's doing it. And the thought is that the reason that that's not happened currently is that the government still requires the essential benefits to be provided in every policy that's issued in every state that's compliant. Okay, so as long as that's still in there, they would have to provide the same benefits in another state. So let's say that gets taken out along with the mandates, the essential provisions. Now what we have is the opportunity for people to go to various states that have lesser requirements, consumer protections, requirements on network availability, and also procedures for claim appeal for denial of care. So what happens is you're going to get a policy. If you get a policy that's issued, let's say in Nevada or something, it may not have the same protections that a policy issued in California, even though the price might be less. And I think, under the ACA, that was kind of like the idea, was that we needed to have a floor on the benefit structure. But again, I think the mandates are, they're subject to being the first thing that's likely to get taken off. And along with that, I believe, would be the essential benefit requirements. So that may not even be an issue. Now, the president of Blue Shield of California, Paul Markovich, he stated that this whole idea of selling across state lines will create a race to the bottom. Like, who can get the cheapest policy with the least amount of benefits and then begin to sell that. So that's one of those we'll see type provisions.
Yeah, but I would think, I guess, I'm a consumer. Although you sell these, you're also a consumer to some degree, and certainly providing advice to consumers like me.
Mm-hmm.
And so, a big concern is going to be the quality of the care that you get. And, is this going to help me really related to my health care and what it's going to cost? In other words, what benefits am I getting for my money? And so, for example, here in California, we know that, Blue Cross, with Anthem Blue Cross and Blue Shield, there's stuff in the newspaper all the time about them basically negotiating with the hospitals and so forth related to their reimbursement and so forth. So if you have an out-of-state provider and if they're not doing that sort of negotiation, you may get a fraction of your medical costs, in fact, paid for, when you actually incur them.
Yeah, I think that's absolutely right. And if they go into some kind of a usual, customary, and reasonable charge basis.
Is it customary in Arkansas?
Well, no, but yeah. So well, that's a good question. So that's basically how most of the plans used to be run. Mm-hmm. You'd have a usual, customary, and reasonable charge for a zip code area, and then the company would draw a line at, say, the 90th or 80th percentile, and anything over that would deem to be not covered by the policy. So basically, that's on your own nickel.
Right.
You know, now everything else would fall in, and then you'd get the percentage, whatever the policy called for. But yeah, I mean, you know, yeah, that's, who knows? I mean, that's the beauty of the PPO and the HMO network is these, the consumer is contractually protected as far as what's being charged. Whereas if you go outside of that, you don't have that protection any longer. And you know, I mean, if they're basing it on something over in, you know, somewhere else, who knows what's going to happen.
Well, folks, believe it or not, we're out of time. We're not out of program, but we're out of time.
There you go.
So I want to thank you so much for joining us and sharing about this. I think it's something that should be of concern to many people. And so keep your eyes on the news, folks. We'll see you next time on Financial Insider Weekly.